Hello, everybody. I'm Javier, a board member at Lifespan. Over the last couple of years, I've been focusing my efforts on bridging the investment gap, or the valley of death as it's known in scientific circles, that currently exists between basic longevity science and more traditional venture capital. This is something that I believe will be deeply impactful in our quest to produce more longevity interventions that transcend beyond just the lab and actually make it into the hands of consumers. Along with my team at Lifespan, we've been thinking of ways to continue expanding access to impact opportunities for a variety of stakeholders, including donors, investors, researchers, startups, and many more. I'm excited to share with you all today one of our most promising projects that we think can be a driving force in getting more longevity interventions from the lab bench to end consumers. The aforementioned project is the Longevity Impact Fund, a donor-advised fund that gives donors the unique ability to impact the longevity sector at a different point in the value chain. These are some of the people involved in the project to varying capacities. You'll notice several of our Lifespan team members here, as well as some other industry leaders who can add lots of value in their respective fields. We'll go over this again a little bit later, but I wanted to give you a brief sense of the kind of caliber team we are working with. To start off, we need to briefly chat a little bit about the systemic issues within the scientific funding landscape. We believe strongly that the entire scientific funding paradigm is broken. The traditional venture capital industry is risk averse and not aptly suited to funding scientific innovation at the earliest stages, and is naturally inclined to seek incremental improvements and safe bets rather than risky and high value propositions. This is even more evident in longevity, where a lot of the technological approaches are so young and require a period of de-risking that most VC funds aren't willing to support. When we dive deeper into the venture capital industry, we see that at its infancy, it really began to emerge as an asset class as recently as the late 70s. All of this prompted by the advent of personal computing. And then as we arrived into the 1990s, venture capital and the GPLP structure that we all know became the de facto way to fund private companies. The world then took these funding approaches that worked very well for personal computing and software-based startups in the late 90s, and more or less made those the default for all other industries moving forward. But science is unique, and over the years, it's become evident that traditional venture capital models lack funding continuity needed to support higher risk sectors. It is my belief that part of the solution will be in creating new financial instruments that are alternate funding mechanisms to venture capital. Examples of potential new financial vehicles that show promise include impact bonds, dividends, royalty funding agreements, gift annuities, and the aforementioned donor advised fund model, which is the backbone of our longevity impact fund premise. I think it's important to also understand where we currently stand in the longevity sector more specifically. There are two large modes of capital that are available to longevity interventions across the value chain. Donations and grants support basic research through donations, while on the other end of the spectrum, we have venture capital, which I've already briefly touched upon, and they typically support commercialization through equity investments. To understand some of the shortcomings of VCs as it relates to scientific funding or longevity funding, we need to understand the underlying practice behind it. Venture capitalists are looking for partially de-risked technology projects to fund with the primary intent of earning profits from these investments. Due to their nature, they are unlikely to consistently make bets on the earliest of such projects, especially those that are in a de-risking stage of technology development. Now, this comes as a shock to many because through popular culture and the general business environment, we are taught a fallacy that venture capitalists are risk-prone and adventure-seeking organizations. However, when working within a VC firm, you realize that most of the day-to-day is actually based around one single premise. Why should we avoid investing in X company? Venture capitalists spend the entire day thinking about what could go wrong and thinking about reasons why they should avoid making investments. They say no to hundreds, if not thousands of companies before they're able to arrive at a single yes. Now, why is this? The table here outlines what risk means to the venture capitalist industry. VC money is perfectly suited to support growth and take on scaling risk. It can even tolerate funding and competition risk because good founding teams are able to pivot around those risks quickly. But it's poorly suited and typically shies away from technology and scientific risk. See, VCs want to have a high degree of certainty that the tech science just works, while they are generally okay with non-tech related risk as they have faith in strong founding teams to iterate and solve those problems on the go. This is not to say that VCs are evil or anything like that. It's just that venture capital as an asset class doesn't really seem to be the best solution for bridging the valley of death in risky scientific fields like longevity. Meanwhile, on the other end of the spectrum, donors are currently limited in their donating opportunities by the available donor products in the longevity market. Most of these products fall into two types of categories: products that support the funding of basic research and products that are funding advocacy efforts. This leaves us with a disjointed capital supply and a clear gap of funding since no one is there to bridge the gap between basic research and venture capital. This has become known around the industry as the valley of death. Interestingly enough, private markets and other industries naturally developed an imperfect but good enough solution to this issue, and that is the advent of the professional angel investor. So you may ask, where are the angel investors in longevity? Shouldn't angel investors be specifically focusing on this part of the value chain to step in on? Well, angel investors face some unique challenges when venturing into the world of scientific investing. And this is not to even mention the more niche and relatively unproven longevity space. What are these unique challenges? Well, in scientific disciplines such as longevity, it is vital that angel investors band together to support longevity companies and together minimize the collective funding risk. This is due to the high ticket size of science deals at their onset when compared to more traditional sectors, and angel investors' typical check sizes by themselves will more often than not be too small to cover entire funding rounds. For this reason, collaboration with other angels to fill out investment rounds and spread funding risk is paramount. Secondly, angel investors operate in a herd mentality. Almost no one is willing to lead. To put it simply, angels demonstrate a chronic lack of conviction as a group, and without a first mover, no funding rounds can materialize. To overcome this lack of conviction within the angel investor community, we typically need one of two things. Angel investors need to already have or be able to, in a reasonable time frame, develop a deep understanding of the subject matter. And the other alternative is to have a trusted high conviction investor whom they can follow and be able to rely on for their due diligence. Through this lens, we can see that in the translational sector, at least, we are left without a major pool of capital to help cross technologies over that funding gap. Meanwhile, angels are generally not able to step in and easily fill the gap like they do in other traditional industries. More broadly, we need an investor whose primary objective is to de-risk promising projects whose technologies are at a stage that are post-grants and public funds, but also pre-venture capital from a technology risk profile. Currently, in the longevity space, there's no investor that has demonstrated this high technology risk tolerance and a high conviction by consistently yielding deals at the earliest stages with some technology risk still involved. If you meet a VC who says they do, trust me, they are lying either to you or to themselves. At Lifespan, we are well positioned to lead this high conviction investor vehicle for a variety of reasons. We have an organizational knowledge advantage, being one of the leading organizations in the longevity space, where team members have a high degree of built up industry specific knowledge. We have complemented our core team with other members who are some of the foremost experts in longevity science to get different viewpoints and understand the science at a deeper level. Due to our donor structure, we have an incentive to be impact driven rather than purely profit seeking. This gives us the ability to seek a blended return model where our bottom line is measured by a combination of impact through de-risking technologies as well as returns to their fund. Additionally, we have the opportunity to leverage our capital by syndicating rounds. Our broad network is an advantage to multiply the effect of donor dollars. And finally, through our many initiatives, we have developed a broad industry credibility that allows us the ability to attract great longevity companies as well as angel investors to continue to build out our syndication network. As evidence of our commitment to impact, we have set up a structure to function in an evergreen format. This means no fund managers now or ever scooping up all of the profits from successful investments, but rather having these investments go back into the fund to help fund even more longevity companies. The idea is that with a single donation, you could theoretically impact hundreds of longevity companies as a return from early investments are then redeployed into more and more companies down the line. This is a very unique structure, and from a donor perspective, it creates a unique value proposition because rather than donating for a specific one-off use case, the donated capital does not have a cap on its impact. It is not used just for a single activity and then spent. Rather, it's invested and can therefore be a seed for impact in perpetuity as long as the longevity space needs this kind of funding mechanism to get going. I probably don't need to tell all of you attending here today this, but I think it's important to just one more time reiterate the magnitude of just how critical these interventions are for the future of humanity. Every day, 100,000 people die from age-related disease, and approximately every second, a life is lost to these age-related conditions. In the wake of the COVID pandemic, these numbers are skyrocketing beyond what we deem possible. It's becoming glaringly obvious that aging is the one true risk factor for most other disease patterns and something we need to take seriously under control. If we don't get aging under our control, a future more deadly pandemic could wipe out an entire generation and cohort of elderly people. I truly believe that a few hundred years down the road, we will look back at this time period and consider this to be on par with eras like the Industrial Revolution or the Great World Wars as humanity-defining time periods where the world was never the same. Societies will look back and wonder how we had a humanitarian opportunity like none other and how we could save 100,000 lives daily, and yet as a collective society, we undermined it and deemed it impossible. Of course, this is all starting to change, as evidenced by our attendance numbers at this conference and due to the efforts of key figures in our industry. The number of aging companies being founded on a yearly basis is increasing exponentially, and it's a good thing too because we will need to put all of our efforts and collective minds towards this problem if it's to be solved anytime soon. With our population getting ever older, the broader longevity economy is also keeping pace. And this trend is only likely to continue. Now you may ask, why is your organization the right one to step in and be part of this solution? The chart here illustrates our position within the ecosystem and why we believe we are in the ideal position to capitalize on this opportunity and identify the most promising technologies to de-risk. We have established relationships with leading research university centers and will continue developing these relationships moving forward. Additionally, we have strong collaborative relationships with other leading nonprofit entities that help us gain access to promising opportunities. And we have built an ecosystem through various initiatives like Lifespan crowdfunding platform, Journal Club, conferences that expand our access to additional opportunities. And over the last 2 years, we built one of the largest and most vital advantages in this respect. And it's the work that we put into building the world's leading group focused on longevity investing, the Longevity Investor Network. By building the Longevity Investor Network, we built a network of investors that gather regularly to discuss investing matters in the longevity space. And it is the ideal onboarding spot for anyone looking to learn about longevity investing. It is also the go-to group for companies looking to raise their first rounds of capital. Over 65 companies have presented to the group over the last 2 years, and many more are in the pipeline. I invite any investor watching now to get in touch with me if they'd like to be part of future calls. In their monthly pitch meetings, companies have 15 minutes to present their material, followed by a 15 to 20-minute Q&A section, and then we reserve some time for an investor-only dialogue towards the end of each meeting. It was through the Longevity Investor Network that we began the process of setting up diligence data rooms, something that we are focusing on very heavily with our Longevity Impact Fund. Our group currently operates rather informally as we function as an intermediary by setting up the pitch meetings and crafting some very basic diligence documents. And then after pitch meetings, investors need to take initiative to pursue individual investments. In just 2 years, we have grown to over 145 members, and the amount of requests to join is increasing rapidly over the last 6 months. Through this whole process of running the Longevity Investor Network, we've been able to take a lot of these learnings to apply to future projects. One of the issues that we consistently face was investors' lack of conviction and no one being the clear first mover to rally the rest of the group. For most of the members, their individual check size is too small and they're looking for other members to commit to the round before they join in. The problem was exacerbated by the fact that many of our members were lacking the scientific expertise to conduct deeper levels of diligence on the presenting companies. They were desperately looking for a way to bridge that knowledge gap and gain the conviction to invest. For this reason, we only saw about 10% of companies receive some form of investment through our network over the last couple of years. Too many projects are dying before they get a chance to de-risk their technology. And so we asked ourselves, how can we scale this impact? And this is by bringing the bridge and intermediary between these two large capital modes. We have the scientific expertise to bridge the gap for angels in our network. And with our incentives properly aligned, we also have the high conviction to lead deals and bring other angels on board. This is how our process would work in theory. When a company makes it through our diligence process successfully, we would craft a syndication invitation for angel investor group members. Individuals are then able to join at varying check sizes available in the round, and then we can distribute the capital in tranches based on company scientific milestones. This leads itself to being an automated process, which we have on our product roadmap, and I'll talk about that a little bit later. So to quickly recap, we bridge the gap by providing capital to longevity companies crossing the valley of death that are too early for venture capital, but too late for basic research grants. We are establishing ourselves as a high conviction investor that is sorely needed in an area where most investors prefer following in a deal rather than leading it. And we collaborate with other investors through our Longevity Investor Network initiative to leverage our donor capital and maximize impact. We know that one group can't do it all, but thankfully we built the infrastructure network to get deals done and push rounds through the finish line. To demonstrate our commitment towards translating longevity technologies, we are seeding the Longevity Impact Fund with $50,000 USD to get the project off the ground. We are inviting other interested parties to participate in launching this ever-important initiative that helps solve a key bottleneck in our longevity sector. To simplify individuals' involvement in the project, we have separated out involvement levels in proportionate amounts to donor contribution size. Contributions totaling $100K or more will be considered founding members of this initiative and will have lifetime full transparency access to our work through the Live Plus product roadmap. Matching 50K contributions will give similar donor access to our work for the next 3 calendar years, while smaller contributions will be added on a yearly basis to our Live Plus platform offering, which I will talk about in more detail shortly. In addition to this, donors at all levels will have a collective investment board vote that will count equal to the voting rights of any other investment board member. We are also allotting the top 3 donors on an annual basis an individual investment board vote. This is a unique opportunity for donors because donors don't often get the chance to tune in with organizational operations or have any involvement in how donor advised funds are utilized, making this a unique proposition for donors who want to learn more about longevity sector and dive deeper into the space with the help of industry experts. Of course, all board votes will need to clear a conflict of interest disclosure prior to dispersing investments to make sure no one leverages this inappropriately. Our goal with this new plan is to drive impact through major translational bottlenecks in the longevity industry. Like I previously mentioned, we're first doing this by implementing an evergreen fund structure and focusing our translational investments into milestone-driven scientific de-risking projects. On a more broad level, we want to grow this initiative to build more than just a standalone donor advised fund and create a thriving ecosystem of tools, resources, and infrastructure to facilitate longevity investing. From an administrative side of things, we aim to keep the operation as lean as possible so that donor funds can be directed towards funding outcomes as much as possible. Our overhead costs will amount to only 2% of total assets, comparing favorably to other organizations' internal costs. Believe it or not, many organizations in the healthcare sector have overhead costs of over 50% of total yearly assets, including some like the Cancer Survivors Fund, listed here, who had a whopping 92% of total yearly assets allocated to overhead costs, with only the remaining 8% going towards meeting their charitable goals. There are countless other similar organizations operating at these dubious self-imposed thresholds. However, other well-supported and reputable organizations that we've looked towards for inspiration are operating at more reasonable rates like the 6 and 12% overhead rates seen here on this slide. Our goal is to hold ourselves to a higher standard and maintain a 2% overhead cost, which we believe we can achieve with the terrific mission-driven team that we have assembled. Speaking about product roadmap, going back to our Live Plus offering, we aim to build infrastructure tools that add value to our donor community and the longevity industry at large. We will need your support to achieve our ambitious product roadmap, but with your support, we plan to pursue aggressive milestones and build additional infrastructure products that build on top of the Longevity Impact Fund. For example, we're currently working on an industry standard diligence process that any future longevity investor can use to evaluate longevity companies in a responsible manner, along with suggestions on individuals and system providers that can help bridge the knowledge gap and aid investors in getting through full diligencing process. We plan to open source this process to serve the larger longevity community, and Longevity Impact Fund donors will have the opportunity to see our team leverage this process internally and participate in parts of it that may be useful to the rest of the team. We also aim to begin tackling some other lower hanging fruit. For example, one of these projects in our release pipeline is creating a longevity investor playbook and case studies to provide guidance that new investors can leverage when entering the ecosystem. On a larger timescale, we also have numerous things in our release pipeline, like creating a longevity-focused syndication platform and diving into building additional financial instruments to facilitate capital flows into longevity, like, for example, a longevity-tailored gift annuity program or a longevity-focused impact bond. As I mentioned, we've been refining our internal diligence process and are leaving no stone unturned to make sure that we are leveraging the best process to vet and invest in longevity de-risking projects. We have a stockpile of internal documents and processes put in place that we hope to share with people as we fine-tune the process and begin actively deploying capital. As an organization, we are in the ideal place to execute on an ambitious project like the Longevity Impact Fund and the infrastructure platforms we hope to build on top of it. Over the years, we've continuously executed on a number of successful projects. We've grown the Longevity Investor Community Network to over 145 members in just 2 years, organized some of the most information-dense longevity conference and gatherings since our inaugural event in 2018, and we continue to provide high-quality coverage of the longevity sector through a monthly Rejuvenation Roundup, Journal Club, and far-reaching news outlet. We are also pushing the envelope in the content creation space by launching a number of new video formats like Lifespan News and the Life Extension Show. Our public Discord servers and Facebook chat groups see hundreds, if not thousands, of messages every day between advocates and longevity enthusiasts, conversing about longevity-related topics, inviting new forms of collaboration. With your support, we plan to do the same with Longevity Impact Fund, one of our most ambitious projects to date. The Longevity Impact Fund is spearheaded by our president, Keith Comito, who is a proven leader in longevity research advocacy, with extensive connections in the field to researchers, press, policymakers, and much more. I joined him in leading this initiative by bringing my experience in founding and managing an early-stage deep tech fund, as well as building the longevity sector initiative from the ground up. Our initial diligence board has some of the foremost thinkers and industry experts in longevity space. People like Chris Verveau and Ashish Rajput bring medical and scientific backgrounds to the team to work with us in building a world-class diligence process. On our investment advisory board, we have several familiar lifespan faces, as well as other industry experts like Kelsey Moody and Patrick Burgermeister to help keep us on the right track. While we have many ambitious objectives in our product roadmap, our first duty of business in what remains of 2020 is to close the first $2 million of assets to begin operations and focus on iterating and finalizing the internal diligence process that will be open source in due time. If you are interested in joining us in this journey or have further questions, feel free to reach out to me through the remainder of this conference or send me a note at javier@lifespan.io.